What's up guys, and welcome back to WSM Research. If you're new to this channel, we provide research on the hottest high-growth stocks on the stock market today. Before we get into the video, keep in mind that we are not financial advisors, and this video is only for informational purposes. A few days ago, we made our first video on Chinese video game streaming company HUYA, and today we're continuing our coverage of the topic with a video of rival streaming giant DOYU. Both stocks have done very well over the past year as gaming and live streaming have surged during the pandemic. This has pushed shares of HUYA and DOYU up 23% and 58% respectively. If you want to learn more about HUYA, check out our earlier video, link in the description below. In this video, we're going to take a look at DOYU and the potential merger of the two companies. DOYU operates DOYU.com, a streaming site where users live stream video games such as League of Legends. Fans donate virtual gifts to the live streamers, and DOYU's revenue comes from taking a cut of these gifts. The live streaming sector in China is experiencing strong secular growth that will benefit both DOYU and HUYA, but which one is a better stock? Two of the most important metrics to look at for these companies are revenue and monthly active users. Both companies are very similar in size and growth. These charts show the quarterly revenue in millions of US dollars and the monthly active users in millions. Both companies have experienced strong growth in the past year and a half, with revenue increasing at a compound annual growth rate or CAGR of 43% and 41% for HUYA and DOYU respectively. These are very high growth rates for companies of this size. HUYA grew its monthly active users at a CAGR of 25%, which is higher than DOYU, which only grew at 14%. But DOYU started at a higher base and currently has 194 million monthly active users, making them slightly bigger than HUYA, which stands at 172 million. Looking at net profit, HUYA has a much more consistent profitability than DOYU, which turned a loss in the third quarter of 2019. But this is understandable as they are investing heavily in new technology as well as marketing. For high-growth companies like these, short-term profitability isn't as important as user and revenue growth, because the profit they make today are insignificant compared to what they will make once they reach maturity. Finally, we have a look at valuation. Neither company has reported their fourth quarter financial results yet, but if we assume a 30% annual growth rate for the fourth quarter, HUYA will make $1.593 billion of revenue for 2020, and DOYU will make $1.42 billion. HUYA has a higher market cap of $5.89 billion compared to DOYU's $4.45 billion. This gives HUYA a price-to-sales multiple of 3.7 and DOYU a price-to-sales of 3.13. On this metric, DOYU is a cheaper stock than HUYA. But you also have to remember that HUYA is growing faster than DOYU, both in terms of users and revenue, and has more stable profitability. So HUYA has a higher quality company at a premium price, and DOYU is a lower quality company but is cheaper. As an investor deciding between these two stocks, you have to decide whether the higher growth of HUYA justifies the valuation. On October 12, 2020, HUYA and DOYU announced that they had entered into an agreement to a merger in conjunction with Tencent. Under the terms of the agreement, each holder of shares of DOYU would receive 7.3 shares of HUYA for every 1 share of DOYU. For US investors, that means that each DOYU American Depository Receipt of DOYU under the ticker symbol DOYU will receive 0.73 shares of HUYA. Additionally, DOYU shareholders will receive a total of $60 million on the closing of the deal in the form of a special dividend. At 320.95 million shares outstanding, that means each share of DOYU will be entitled to be paid 19 cents from the dividend. Likewise, HUYA will also pay a special dividend to their shareholders of $200 million collectively, or about 85 cents per share. Based on these numbers, the merger implies that each DOYU share is worth 73% of a HUYA share minus 66 cents. Currently, DOYU is trading at $14 a share, while HUYA is trading at $25 a share. 73% of a HUYA share minus 66 cents is $17.59, which is significantly higher than what DOYU is trading at right now. So if the merger happens, then the current stock prices are too far away from each other. If you short 100 shares of HUYA and long 73 shares of DOYU, if the merger happens, you will make a guaranteed $170.84 of profit. So why does such an obvious mispricing exist in the market? It turns out that there are major questions as to whether this deal will actually go through. Near the end of 2020, it was reported that Chinese regulators were probing the deal. Apparently, the combined HUYA and DOYU would possess more than 80% market share in the live streaming business in China. And we all know that Chinese government does not like private companies having that kind of power. Especially after what happened with the Ant Financial IPO that got scrapped and Jack Ma's famous apparent disappearance from the public eye. But DOYU and HUYA are nevertheless great ways to play the secular growth of video game streaming. The key issues driving these stocks are their valuations, growth, and the potential merger. The potential merger benefit and cheaper valuation favor DOYU, while the better growth and profitability benefit HUYA. Let us know in the comment section which of these you think is better, or if you think that there are any other high growth stocks that are good. In the meantime, make sure to smash the like and subscribe buttons, and we'll see you in the next one. WSM Research, signing out.